Hi everyone and welcome to our end of year tax planning webinar. My name's Belinda Crowley and I'm a director in the tax advisory division at Vincent's, and I'm joined today by Natasha Wilson, who is a manager in the tax advisory division as well. And today we're going to walk you through some of the matters you need to think about, I guess, ahead of the end of financial year. We do have a separate sort of standalone planning document, and there's a checklist there as well, which I'd encourage you to look at. And a lot of what we're talking about today, there's some shared themes between those documents and what we're going to speak about, but sometimes helpful just to have a chat about it as well. Main areas that we're going to cover off on is some of the considerations for businesses and in particular trusts and entities with Division 7A loans. There's obviously quite a few things that need to be dealt with before the end of year for those entities, which are quite particular for them. So we'll talk to some of those. We've also got some notes, I guess, for individuals and just some tax planning ideas for them, and just quickly on superannuation as well. I will refer you though to a webinar that my colleagues Mai Wheeler and Brett Griffiths did around superannuation. That webinar in particular discusses the new Division 296 tax, which is obviously a big change for the year coming up. So I'd really strongly recommend that to you if you're looking for some further detail around superannuation. Okay, so we'll just begin with some of the considerations that are more specific for businesses in themselves. And I think just at the outset, the end of financial year is always a great time to revisit the structure that your business is within. Sometimes, things change. The priorities change. There might be changes within your family, changes within your business itself. You're looking at expanding, perhaps going offshore, new financing. Some entities are looking at getting new investors. All of those things, the structure of the business is quite important to how those work. And so the end of financial year is quite a good time to have a look at that structure itself. For those looking at going offshore, for example, setting up new entities, separation of risk, that can help. Having an overall review of the structure before you move into those and getting ready for those. Asset protection is obviously the other major item with the structure review, making sure that that's fit for purpose, that it allows transfer of wealth to the next generation, and we can make some small tweaks which can facilitate those types of things. Just on the bringing in new investors, the other item there that often comes up is things like usage of carry forward losses. Once you bring in new investors, using losses can be a bit more difficult. And so if you're considering that, that's a sort of a tax planning point where rather than looking to defer income, you actually might be looking to bring forward income so that you can use up those losses and there's less risk of losing them going forward. Just more generally, obviously that point around the timing of income derivation. So generally income is derived when you've sort of done everything that you need to do in order to receive that income. So you've fulfilled all your requirements under the contract. And that's the point where income generally becomes assessable. It is different for those taxpayers who are on a cash basis. For them, it's when they actually receive the cash. But for most groups, you're on an accruals basis of taxation. And so that sort of point of derivation, to the extent that that can be perhaps moved to the next year with sort of genuine commercial reasons for it, that will provide a tax advantage to you in terms of the timing. So things like progress payments, when you invoice your progress payments, that can make a little bit of difference to the income that you're paying tax on. Similarly with your deductions, to the extent that they can be brought forward, that can also provide a significant timing advantage. Generally, the ability to bring deductions forward depends on the type of taxpayer you are. So larger groups, their ability is a little bit more limited. And when I talk there about larger groups, I mean taxpayers with aggregated turnover over $10 million. Generally, the ability to sort of pre-claim deductions is limited to amounts that are less than $1,000 or those that are required by law. So things like rates, work cover, those types of things. So where you're a smaller business, and this is businesses with income below $10 million, those entities can claim deductions for amounts of up to 12 months prepaid expenditure. So there's a little bit more flexibility there. So things like interest, to the extent that you can prepay interest, that might be able to bring forward those deductions. I think the point around aggregated turnover is an important one. And Tash, often this is an area where taxpayers sort of get a little bit confused, but obviously aggregated turnover looks at the turnover of the whole group.
Yeah, definitely, and agree that it definitely trips some businesses up. So the thresholds are really based on entities connected with and associated with, whatever entity it is that you're looking at. So it's really important that you're taking into consideration all of those turnovers, and you can end up with a much different result than what you would if you were just looking at the single entity. So generally, as I said, it's looking at whether the businesses have control of each other and whether they're controlled by the same third party as to which businesses and entities are included in that test.
Yeah, I know it is a difficult area, particularly where you've got third parties involved as well.
Yeah.
One of the other areas where the aggregated turnover test is really important is around the instant asset deduction. So again, this applies to businesses with aggregated turnover below 10 million, and this enables you to immediately deduct expenditure on assets of up to $20,000. So normally that threshold is around $1,000. So this is quite a big advantage for those smaller businesses. Just a reminder that the asset needs to be installed and ready for use by 30 June. So it's not enough to have just ordered it or even paid for it. It needs to be installed on your premises and ready to use. But certainly that's quite a big advantage for those businesses that fall within that turnover category. Just a couple of, I guess, more sort of housekeeping type matters. Just the documentation around evidencing deductions is becoming increasingly important with the ATO. We've seen quite a few cases go through the judicial system in the last 12 months around what documentation that the taxpayer has, and the ATO trying to, I guess, attack those amounts, saying that they're not genuine. So obviously, sort of as a starting point, having receipts for everything, but going further, particularly with intercompany arrangements, having agreements that set out what you're charging between entities and why you're charging it is becoming increasingly important. So to the extent that you have those sort of management fees, buying stock between entities, sharing employees, that type of thing, all of that needs to be documented so that there's no sort of question if the ATO comes knocking. The other part of that is the GST part of it, and quite often entities think sort of it's in one entity and it's out in the other. Under the GST law, that needs to be charged between the entities. And so while the net sort of benefit is nil, the ATO, if they do come along, they can charge interest where the GST hasn't been appropriately accounted for. And there are some cases where they can just deny the credit. So really important to make sure that those intercompany charges are properly documented, both from an income tax perspective, but also from a GST perspective. I guess on the bad debts, it's not enough to just provision for the bad debt. It needs to actually be written off in the accounts. That is, you as a business have decided that you're no longer going to pursue that debt and you're effectively letting it go. So that's the point where the tax deduction is allowed. It's not the point where you just provide for it. So it's important to actually think through the debtor position of your business in terms of who is going to actually pay, because if you can write them off, then that brings forward that tax deduction. The super contributions, obviously they need to be paid by the relevant date. Where they are late, they are not deductible. And so for the 30 June 2026 year, they need to hit the fund by 28th of July 2026. Keep in mind, and we'll talk to this later, but the payday super provisions are going to change some of those positions. Another one point, I guess, that's quite different for this year is that the interest paid on ATO debt is no longer deductible. So this applied from 1 July 2025. And from that point, any interest on ATO debt can't be deducted. So I guess it's an important point to think about the financing of any tax debt. And it's acknowledged that some taxpayers do have tax debt. If you're just letting it sit there outstanding to the ATO and accruing interest, you don't get to deduct that amount. Whereas if you've got that in, say, a wider working capital facility, then the interest on that facility generally will be deductible. Keep in mind also that the ATO's interest rate is fairly comparable now to commercial institutions. So there's no longer sort of an arbitrage benefit there. I think we are seeing a lot more activity in this area as well. And Tash, certainly, I know that we've talked about this, the ATO increasingly pursuing unpaid debts.
Yeah, there's definitely been an uptick in recovery action and also an increasing unwillingness to remit the general interest charges on that tax debt. So previously it was, I think it's fair to say that it was a lot easier to have interest remitted, but there is now a much more formal process in place that's been implemented in the last 6 to 12 months for requesting the remission of interest, and definitely seeing that the ATO is looking at those applications much more closely and rejecting them much more frequently than they were previously. So I definitely wouldn't say that a good strategy is relying on the fact that you think you might get the interest remitted, because that definitely may not be the case.
Yeah, no, and I think certainly there's an increased use by the ATO of sort of these automation technologies, taking out the human side of it, and that obviously makes it harder to get remissions, because the computer's not really thinking about particular personal circumstances. It's just making its decisions based on an algorithm that's built into it.
Yeah.
For those businesses that are conducting R&D activities, definitely speak to your advisor around whether you're eligible for the R&D tax incentive. So generally the types of activities that qualify for the R&D incentive are those where you're doing something new or novel, or where you're trying to build something where you don't know whether it's going to be successful or not. And the R&D tax incentive can be quite generous for some taxpayers. Certain taxpayers actually get a cash refund of some of their expenditure, which is obviously a massive cash flow boost for those entities, which can often be investing quite a large amount in R&D. Finally, just around businesses, particularly those in the primary production industry, there are a lot of tax concessions aimed at that industry to, I guess, alleviate the difficulties, the seasonality of it. Just a couple of those as a reminder. So where you've had a forced disposal of livestock, for example, due to a drought or a flood, the profit from that disposal can be spread over 5 years. So it does allow you to break it up a little bit. Alternatively, you can, I guess, use the profit on that disposal to reduce the tax base of the existing stock. Therefore, you're effectively carrying forward, deferring that amount of income until you sell the replacement stock. The income averaging provisions still remain for individuals and trusts, although for those who are expecting, I guess, a permanent reduction in income, so perhaps you're moving towards retirement or similar, sometimes it's advantageous just to move out of that regime earlier. So something to think about as you look at those provisions. Also, there's a bunch of immediate deductions available for things like fencing, for fodder storage, for land care operations, particularly around sort of water, transportation and those types of things. And just finally, I guess the increasing awareness in the industry of sort of carbon schemes and generation of carbon credits. There are some quite specific rules around those sort of credits and how they're treated for tax purposes. So if you are looking at entering into those schemes, or you have recently entered into those schemes, certainly it's important to talk to accounting advisors, but also legal advisors, because there's quite a few traps that landowners can fall into, which produce some fairly unintended consequences. So I'll now pass over to Tash. She's just going to talk through some of the more trust-specific issues, and then also work through some Division A considerations for year end.
Great. Thanks, Belinda. So yeah, moving on to trust. So if you do have a business or investments that you run through a trust entity rather than a company, trusts are becoming more increasingly a bigger focus of the ATO, and the ATO are devoting a lot more compliance and audit resources to various trust issues, and can become quite messy. So we're going to run through some of those issues and things to be aware of that we need to have sorted out before 30 June when we're looking at tax planning. So I think one of the key things that everyone with trust needs to be considering in tax planning, particularly for discretionary trusts, is trust distribution resolutions, which must be decided and signed by 30 June at the latest. That also depends on your trust deed. So some trust deeds may actually specify a slightly earlier date in the month that they need to be decided by. And to ensure that distribution resolutions are effective, trustees need to ensure that the requirements of the trust deed are followed, and that any corporate trustees constitution and also the Corporations Act has been complied with. So we also need to be looking at things like when we're deciding on beneficiaries to include in those resolutions, whether they are allowed as beneficiaries under the trust deed. So the issue is that if you get any of these details wrong in the resolution, it can be deemed to be an ineffective or invalid resolution. Also, if it's not completed by the relevant date, usually by 30 June, then it will also be an ineffective resolution. And the effect of that is that the distributions that you thought you had resolved on that resolution will be ignored for tax purposes, and the trustee then gets it assessed at 47% instead. So it's quite a harsh consequence of potentially just getting a small detail wrong on that document. So it is a very important document to consider and have completed as part of your tax planning. So that means we need to have a really good idea of the income of the trust estate for the year, as well as any significant transactions that have occurred during the year, like the sale of CGT assets. So if you've sold any properties or sold a business or any other assets, we need to know about that to be able to effectively consider what it is that needs to be distributed out of the trust for the year. The other thing on distributions is that trustees are obligated to exercise their discretion in good faith. So they need to have what's called real and genuine consideration of all the potential beneficiaries of the trust. So as a trustee, you need to be ensuring that you're aware of all the potential beneficiaries and the circumstances of those beneficiaries as to who actually might need a distribution. And there was a case in the last couple of years known as, it's called the Owies case. And in that case, the beneficiary challenged the distribution because they didn't receive one, and the beneficiary who did, they thought that they were in more need of the distribution than that beneficiary. So what happened there is that the distributions can be made ineffective in that case as well. But you can also get all kinds of disputes between beneficiaries happening, which is not ideal. Okay, so there's also a requirement as a trustee to ensure that beneficiaries are aware that of the distributions that they've been made entitled to, and they do have a legal right to call upon that distribution and be paid it at any time once they've been made legally entitled to it under the resolution. So it's important to be aware of that. And with that in mind, we also need to be ensuring that that beneficiary is going to receive the financial benefit of that distribution. It may not be immediately, but if it is going to be left unpaid for a while, we need to ensure that it's not going to somebody else. So there's a requirement under Section 100A of the 1936 Tax Act that requires that essentially those beneficiaries are receiving those distributions. So, and that we don't have what's called a reimbursement agreement where the financial benefit is actually going somewhere else. So, for example, if you make one beneficiary entitled to the distribution on the resolution, but then another beneficiary actually receives the cash, that's going to be potentially an issue for Section 100A. And you get a similar consequences to what I was describing before, where the trustee gets assessed at 47% instead. So that's a really important consideration. And also where Section 100A might apply is if you're making distributions to corporate beneficiaries. If the trust is a shareholder of that corporate beneficiary, basically we don't want that situation, because what happens there is that corporate beneficiary is then paying a dividend, but the dividend has to go to the trust again. So you're essentially ending up with a circular distribution, which the ATO really doesn't like either, and will very likely devote compliance resources to those kinds of scenarios. So lots of things to consider when we're looking at who we're making those distributions to, and all of those things do need to be considered prior to 30 June and decided upon. So last but definitely not least, we also need to consider family trust elections. So firstly, we need to look at whether we have any in place, and where you do have a family trust election in place, there will be a specified individual who was determined when that election was made, and all distributions need to be made within the family group of that individual. So that includes certain family relatives, as well as certain companies and trusts where you need to have specific ownership requirements, or else if they don't meet those requirements, then you need to look at interposed entity elections and whether they need to be made to allow distributions to go to certain other entities. So the consequence for distributing outside of the family group of that specified individual is that family trust distributions tax applies, and that's again at a flat rate of 47%. So definitely want to be making sure that we are staying within that family group. And then, Belinda, there's also some issues to consider with, when we might need to put a family trust election in place as well, and the considerations we still need to have before 30 June.
Yeah, definitely. And it's not something that you would do sort of unless you needed to do, just because of those consequences that you've spoken to around the family trust distribution tax. I mean, the main reasons that you would have a family trust election in place are where you're looking to move franking credits through the trust. Where you don't have an election in that place, the franking credit itself can't be utilised by the beneficiary, which is obviously a massive disadvantage. So quite important to have one in place where that's the case. The other reason that you might enter into an election is where your trust has losses. Under the loss rules, losses can't be used by a trust unless it has one of those family trust elections in place. It just can't meet the relevant test that the legislation sets out without one. So and I think the other thing there is just to note the bit around the timing. So that if you're making a new election, the election itself doesn't need to be made by year end. But if you're anticipating making one, then you need to make sure that the distributions you make in that particular year are to individuals within the family group, obviously to avoid that family trust distributions tax issue that you spoke to, Tash.
Yep, absolutely. Yeah, definitely recurring. A recurring consequence is that flat rate of 47% that can arise when you get things wrong in trusts that we really want to try and avoid as best we can. All right, so just moving on to some Division 7A considerations. This is definitely a very hot topic in tax planning and pre-30 June as well. So Division 7A applies to loans and payments received from a private company or paid by a private company to its shareholders and associates. It can also apply to forgiveness of loans, so you need to be aware of this if you are looking at forgiving loans, and it can also apply to the use of assets held by the private company, so that's definitely an area that can trip people up and can go unnoticed if we're not having, proper discussions about these things. So, for example, if a private company owns a property but a shareholder or associate was using that property for private use, that can be considered to be a payment for Division 7A purposes, and if it's not dealt with appropriately, can lead to fairly harsh tax consequences, which generally include, under Division 7A, deemed unfranked dividends. So an amount equal to the market value of the provision of that asset will be decided and basically treated as income in your tax return without any benefit of franking credits. So a few things that we need to look at when doing our tax planning. Firstly, with our existing loans, we need to assess whether, if you've got any existing Division 7A loan agreements in place, whether the minimum yearly repayments have been met or whether they can be met by way of cash repayment by 30 June. So, of course, if you can make your repayment with cash, then there won't be any tax consequence on that. But if not, and there's not sufficient cash available, then we need to consider whether a dividend can be declared instead to facilitate the repayment. So that would be where the shareholder receiving the dividend uses the funds to repay the loan. So you need to be considering there, who the shareholders are and who the borrowers are, because if they're different people, the shareholders need to agree that that dividend is going to be used to repay the loan. And where we are using dividends, we need to have appropriate documentation in place and signed before 30 June as well. And I also just wanted to note on that that's something that includes a dividend resolution, but it also includes a sort of a loan offset resolution that we need to prepare where a dividend is being used, basically saying that the shareholder agrees to use that dividend as a repayment. This is something that the ATO is placing more focus on recently. So previously, it was a little bit more ignored, but now it is something that when the ATO are doing audits, they're asking for that documentation and asking that you're able to show that it was in place and all decided prior to 30 June. If that's not the case, then the repayments can be deemed to be invalid, and you end up with deemed unfranked dividends, as I said before. So no benefit, no franking benefit for tax that the company has already paid. It's just a straight unfranked income amount in your tax return. Also, just leading on from that, I wanted to quickly touch on the validity of cash repayments for Division 7A purposes. So if you are making a repayment with cash, it's important to note that the cash needs to stay in the company, so you can't then go and take it back out straight after 30 June. So what would happen there is if the same or a similar amount, so it doesn't have to be the exact same amount being taken out, it can be more or less, it just has to be somewhat similar. If the funds are drawn back out, and it's reasonable to conclude that you made that repayment with the intention to just redraw the funds again at some point, then the repayment can be disregarded for Division 7A purposes, and you again then end up with deemed dividends because you haven't met your minimum repayment requirements. So we can strategize and look around the group for availability of cash to meet those repayments, and sometimes that can be a good option to avoid having to declare a dividend and pay tax on that instead. But that you have to be in a position where the cash can stay in the company if that's how we're going to do it. So then looking to any current year loans, so amounts that have been drawn from the company during the current year. As part of the tax planning, you'd then be looking at whether they can be repaid with cash before the end of the year, or maybe whether another entity that's not a corporate entity can basically finance that borrowing instead, so that we don't have a Division 7A obligation going forward. And we also might look at the option of whether it's actually better to just pay a dividend for the full amount now, utilise our franking credits if they're available, and wear the tax cost of that now rather than having ongoing Division 7A obligations. So it's really a matter of weighing up the alternatives. And the Division 7A interest rate has crept up quite a lot in the last few years as well. So that can come at quite a cost, where you are having to continue to use dividends to fund minimum repayments. And the other thing that I just wanted to touch on was where trust distributions are being made to corporate beneficiaries. So if that's happening and the distribution is remaining unpaid, so basically you're making the distribution on paper, but the cash is not immediately flowing to the company from the trust, then consideration needs to be given as to whether that unpaid entitlement will give rise to a financial benefit by the company to the trust, and therefore Division 7A consequences. So the long-standing ATO view on that has been that this is considered to be a financial benefit. And you may have heard mention of the Bendel case, which has been floating around for quite a while now, and we're still waiting on the final outcome of that. But that court case could see some changes made to this view. However, because we are still waiting for that outcome, the ATO is still proceeding on the basis, or proceeding based on the view that such distributions will constitute financial accommodation if they remain unpaid. So still definitely need to be very careful around that as well. And then there's also, when we're sort of, Belinda, weighing up the options there of whether to put a Division 7A loan agreement in place, we do need to be considering whether that is the appropriate strategy for a client as well.
Yeah, I agree. And I think it's important to remember that Division 7A is really just a deferral mechanism. You're just deferring the tax. So at the end of the day, it all does need to come home at that top marginal rate if that's where it ends up. I think often you actually end up paying more tax under Division 7A arrangements because of the requirement to charge interest, which in itself gets taxed as well. So, sometimes the pain is short term, but where I guess that can be sustained over a longer term time frame, you're actually better off dealing with the tax sort of on the income as it comes through.
Yeah, totally agree.
Okay, so maybe just coming back to some of the individual considerations to think about in the lead up to year end. So we've just got up on the slide there the individual rates for the 2025-26 year. They're largely unchanged, although I just note that those rates don't include the Medicare levy, which obviously adds an additional 1.5% to 2% depending on which tax bracket you're in, and they also don't include the Medicare levy surcharge, which applies to those over a certain income who don't have private health insurance. Just a quick comment. There's obviously been some talk in the media around the government announcing a standard $1,000 deduction for taxpayers going forward. Just a reminder that that doesn't apply in the 2026 year. So we need to wait for the 2027 year. So you need to continue to maintain appropriate records for deductions claimed in the 2026 year. You can, of course, continue to claim the working from home expenses, although the ATO has tightened up its evidentiary requirements there. They sort of put some guidance out now saying that they expect taxpayers to be able to evidence their working from home arrangements. So, for example, if you have an employment agreement that says that you have a hybrid working arrangement, or logbook or diary evidence or similar, just showing that you are actually working from home on the days that you're claiming. Another common individual deduction is, of course, motor vehicle expenses, and a reminder that there are two methods that you can utilise to claim those costs, the first being the cents per kilometre method, although that is capped at 5,000 kilometres. So for those taxpayers doing a larger amount of travel, that might not be the most suitable method. The other method available is the logbook method, which allows you to pick up a percentage of the actual expenditure, but it does require you to have maintained a valid logbook in order to claim that portion, generally just done on a personal versus business use percentage. For those individuals who are anticipating capital gains in the year, just a reminder, capital losses can be carried back and applied against capital gains. So if you're holding some assets which are sitting on an unrealised loss and you have had or anticipate having a capital gain before the year end, and you are thinking of selling those lost assets anyway, before year end may be a good time to sell them. Just a quick word of warning, though, the ATO does take a particularly harsh view on taxpayers who sell an asset in order to crystallise a loss, but then reacquire the same or a very similar asset. They will deny the capital loss in those cases. So the sale needs to sort of be something that's genuine. That I guess the economic exposure needs to change from a taxpayer perspective. As Tash said earlier, just with the capital gains, the timing is obviously when you enter into the contract as opposed to any settlement time. So for contracts that straddle year end, remember that if it's before 30 June contract date, the gain is a 30 June 2026 year. Finally, just a quick comment around anyone who's perhaps thinking of leaving Australia in the short term. The departure from Australia can cause a change in tax residency, which has some quite significant tax impacts. In particular, there can be a deemed disposal of all of your assets, which can, give you a significant bill if you're not expecting it. So if you are thinking about moving, perhaps for work reasons, make sure you're engaged with your Vincent's advisor early on that, just so that you can fully understand any implications of that.
I was also going to just note there that can also have an impact on, the main residence exemption and how that applies to your own residence as well. So definitely important to know the impact, any potential impacts there as well.
Absolutely. Okay, just quickly, finally, just touching on the payday super changes which are coming. There is a separate webinar available by some colleagues of mine, Anna and Simone, which really goes into these changes in quite a bit of detail. And so certainly I would recommend that because they are quite substantial. So it does commence from 1 July 2026 and there is no sort of transitional period. It's straight into it. A reminder that the superannuation now needs to be paid within 7 days of the pay cycle. So need to be ready to go on that from 1 July 2026. There also have been some extensions to the payments which now qualify for superannuation. So for example, salary sacrifice superannuation is now also subject to super. So for taxpayers who have sacrificed income into their super, previously you didn't have to pay superannuation on that, now you do. As I said, there is a separate webinar on those changes. The super payments do need to be reported through your single touch payroll every cycle to ensure compliance. And the ATO is doing a lot of data matching around that, which I'm sure will continue to pick up sort of differences between payment and receipt. Just moving on finally, I guess, to super contributions more generally. So a reminder, it's still at the 12% rate for the 30 June 2026 year, and it is remaining at that rate going forward. A reminder that late payments are not deductible, and contributions for the June 26 quarter are, as I said earlier, to be made by the 28th of July 2026 in order to make sure that they are deductible. The cap, obviously 30,000 for all individuals, and certainly an area that can trip taxpayers up or employers up if they're not vigilant on it. With the payday super though, that's obviously going to change things quite a bit going forward. Okay, and I think that brings us to about all the things that we wanted to discuss in today's webinar. As I said at the outset, there is a separate planning document and checklist, which I'd really encourage you to look through. It goes into a little bit more detail on some of the things that we've spoken about, and certainly your Vincent's advisor as well will be a wealth of knowledge and someone who you should always speak to leading up to the year end. So thank you for taking the time, and hopefully you found it of value.
Thanks, everyone.
Thank you.